Episode 554, Trading Justice Podcast. Matt and Mark here, Adjusted Boys. Going to break down some Nvidia earnings. Bottom of the market, RSP, small caps, Home Depot looks a lot better than top of the market to us. We'll break down that analysis. Lots going on this week, but none of it matters. We'll break down that analysis. Even Powell speaks this week, Matt, on Friday, 11 a.m. Eastern. I don't think that matters. We'll break it all down. Gold, interesting little spot it's in. Bitcoin, interesting spot. Well, we got lots to talk about. How you doing?
You know, Chuck, doing good. Excited to be here for another edition of the podcast. And I loved what you said just barely. There is a tremendous amount on the docket this week. You go look at the economic calendar, it's like, whoa, we got a big week. And it's like, there's not a report there that is really going to matter to the marketplace. And I just want to do a PSA to Forex Factory right now and other economic calendars. Can we stop labeling every single report red? Like you're watering down the labor market in the CPI reports. That's all I'm going to say. Or give us another color that signifies these are the two most important reports and everything else is secondary. That's CPI, that's labor.
Conference board consumer confidence on Tuesday should not be red, Forex Factory.
No.
It just shouldn't.
No. There are two major reports, labor and inflation. Everything else is secondary.
And unless inflation is surprises to the upside out of nowhere, it doesn't matter either.
Yep.
We're basically down, man. Let's talk about that for a second, since we were going to talk about it anyways. We're at a point in the narrative right now where inflation done, Fed done, right? That's part of the narrative. You can disagree, you can wax poetically. That's part of the current narrative, whether you like it or not.
As of right now, the Fed is done. Unless the data changes, the Fed is done. This pause will lead into cuts unless the data changes. So based on the current market mentality and the current narratives that are building throughout the market, Fed is done. Absolutely. You and I were on that for a long time now. The rest of the market has caught up to that. Yeah.
And the other part of the evolving narrative is where the debate is being held is all right, do we have slowing growth? Does that slowing growth lead to something major? Do we have a soft landing on the docket? Basically the conversation that's been held for 18 months, off and on. And since the market has nothing to talk about. Now, you and I are both of the opinion that narrative will go back and forth until if unemployment breaks and you basically see a spike on an unemployment, which basically means, Matt, you have one red report that's super, super red every month, and lots of other data points that give us something to talk about. But, when I think of economic reports, Matt, I'm like, should I trade around that economic report? And you know what I mean when I say that, right? Should I put on breaks around that? Should I manage covered calls around that? Should I navigate?
I have to take it into account in part of
in my day-to-day decision.
Is what I need to do.
Yeah. Yes. And there's only one for the next 6 weeks for me, Matt, and it's the unemployment report on December 8th, I think it is.
It's 2 weeks.
So the December 8th, 2 weeks from now. But Matt, the rest of it's noise and probably will be noise, like something to talk about. But what do you think about all that?
I certainly agree with that. I've agreed with that for a very long time. Many of these economic calendars out there, Forex Factory is our favorite at Tackle Trading, but many of the economic calendars out there have so many different economic reports, colored red, colored orange, given a level of, credibility to the report, making it an all eyes moment, when the simple reality is there's been only two reports that were major for the past 18 months. And that was CPI and that was labor market numbers that come out the first Friday of every single month. Outside of that, there hasn't been major reports in that really moved the market other than the Fed. The Fed obviously is part of that equation as well. But when you're looking at GDP reports, when you're looking at manufacturing reports, when you're looking at retail reports, when you're looking at housing data, when you're looking at unemployment claims, even unemployment claims is an important report as it's tied to the labor market, but I wouldn't put any report that is a weekly report in major territory when unemployment claims has been around 210, 220, 210, 230,000
Yeah,
initial
and it's
claims
moved up, it's moved down.
months.
It's yeah.
And so these economic calendars in a moment of economic sensibility or sensitivity, I should say, in that moment, these economic calendars had made every report matter a little bit more in terms of the general sentiment out there, when the simple reality is it's been more concentrated, and it's very, very similar to the Max 7 versus the rest of the market. The Max 7 is extremely concentrated, and yet there's 493 other stocks that are still, fairly important, but I wouldn't say they're at the same importance of, say, when Nvidia reports earnings. It's an all eyes moment. When Intel reports earnings, it's people who invest in Intel. Same conversation with the economic calendar here. We probably went to the opposite way of what we should. Many of these reports that we're seeing, like new home sales, for example, usually a yellow report, consumer confidence, usually an orange report, preliminary GDP, I would certainly put as a red report. It's the first GDP report in the process, but I wouldn't color it red based on the 5% expectation on that preliminary quarter-to-quarter GDP report. OPEC meetings, I would certainly put as a red report this week because it's OPEC. It's one of the major things.
It's red for oil,
right? But it's not red for the market.
But it's not red for the market.
Core PCE index, I would put as red, just given the fact that it's tied to inflation. It's the Fed's preferred gauge. But outside of that, Mark, I think we've probably been a little bit too sensitive to these secondary economic reports when everything to the market matters. And let me just put it like this. None of these other reports matter that much as long as the labor market doesn't break. Would you agree with that?
Every one of these reports can come in soft for the next 9 trading sessions. And if unemployment is strong,
it doesn't matter.
It won't matter because the narrative won't change. Because
but can we talk about why that narrative won't change, though? Because in your estimation, why do you think that narrative won't change if labor doesn't break?
Because if labor doesn't break, you have this interesting dynamic where the Fed isn't going to be in a rush to cut. We're starting to price in cuts next year.
I think
let's say, and so we're starting to price that in. This is part of the, all right, Fed done, inflation done. We don't know where the economy is going. But if all of a sudden you get a strong unemployment number, I don't care if every one of the rest of these numbers are soft. Those cuts
still spend money
because consumers will still spend money, and there will be no strong push for the Fed to cut. There will be the expectations of cuts. You'll see them start to drop, and you might even see yields start to climb a little bit if that's the case. And so without the unemployment report changing, either really strong, really weak, the narrative's not going to change. Now, if you have a really strong unemployment report 2 weeks from now or a really weak one, that will change the narrative for the month of December, right? Heading into the new year. But everything else is so irrelevant from a narrative standpoint until then. Like, unless you saw something like really, like if ISM manufacturing PMI came out at a 42 instead of a 47 point, you would have to see something really dramatic.
I'm not sure that would break the market, though. That'd be good news, bad news type environment.
Yeah, I mean, until so.
I think everything revolves around labor right here, because to me, when you mention the narrative, I'm thinking the big picture narrative based on earnings going into next year. And right now, when you're talking about earnings going into next year and the estimates on earnings next year, if everything comes through, meaning we don't go through a recession and labor doesn't break, you got a really compelling value argument coming from the low points on many, many, many areas of the marketplace. You got a really strong argument on the earnings landscape regarding the RSP and the rest of the 493 stocks that are not the Mag 7, that are not Apple, Microsoft, Google, Amazon, Nvidia, Meta, and which one, Tesla. And so as long as labor doesn't break, it's really, really simple to me. As long as labor doesn't break, you're not having a recession. And if you don't have a recession, you're not going to see a catering earnings estimates next year, which means the valuation argument that we're having right now coming from the low point is would be confirmed going into next year. And so to me, it's a macro argument regarding earnings going into next year, where valuation is on the forward valuations in RSP in comparison to the Mag 7, which are a little bit elevated right now from a valuation perspective. And so, yeah, I think a lot of everything we're talking about over the next 2 weeks. Don't get me wrong. We'll talk about the consumer confidence report on Tuesday, and we'll talk about OPEC meetings on Thursday, and we'll talk about manufacturing on Friday, and we'll have those conversations in the Tackle Trading Halftime Report every single day on our YouTube channel. But are they vitally important for the broad market? I would say no. I would say the same thing about the Fed speeches this week. I would say the only reports this week that we need to really kind of focus on that can move the market are the PCE price index, which is inflation, preliminary GDP, which is the first one in the GDP conversation, and then OPEC. Outside of that, even Jay Powell's speech on Friday, I'm not too excited about. So it's not a massive economic week, but it looks that way when you go to calendars. It looks like one of those weeks where it's like, all right, we might need to sit on our hands a little bit and wait for this, barrage of data coming in of all these major economic reports coming in. And it's like, man, changing color codes, guys. There's only two major economic reports that stop everybody in their tracks regarding what they're doing, and that's labor numbers and that's CPI, and even CPI. I love what you said earlier. Even CPI is taking a backseat to labor right now. It's labor and labor, inflation, everything else.
Yeah, no. And so with that tactical backdrop, which gives you a lot of flexibility, when you only have to trade around one major economic report and can pretty much pay attention to, but filter out the rest as noise, that gives you a lot of luxury to say, all right, I can do all kinds of stuff. Right now, we find ourselves in bullish conditions that refuse to break. We find ourselves in bullish conditions that have shown no signs of shifting volatility, something that I promise you, as soon as we see, we will discuss.
That first candle out.
Yeah, until we see shifting volatility, and be prepared to act if you do, cut back, take profit, whatever it is, if once shifting volatility, just to be cautious, take back, cut back. But until then, it is like, all right, where bullish trades do I do this week and where do I look? And for me, there's a few chart patterns. First, we got stocks that have skyrocketed that have shown no signs of abatement since the rally began almost a month ago. Mag 7 come to mind, but you have stocks like Visa, you have other stocks that have just parted. Those don't interest me as much as kind of that mid-tier RSP, Home Depot, things at the bottom of the chart, things that have enjoyed the rally. There's very few things that have not enjoyed
a lot at the bottom of the chart.
Yeah, you don't have so
like upper level and mid-tier now.
And it's that mid-tier.
I remember asking you and everybody at Tackle Trading a question. I can't remember what program we were in, but I remember sitting down and I asked them, what do you prefer, bottom, mid-tier, upper tier, right? Bottom tier is those stocks that are just dogs of the Dow. They've been catering. They have had no bullish love. Mid-tiers, doing decent, above the 200-day moving average, but getting carried by the Mag 7 to a certain extent. And almost everybody, I don't want to say everybody, but almost everybody in that class basically stated, I like the low tier, including me, yourself, and I believe Frank was there as well. There's not a lot in that level any longer. There's reversals that have been confirmed that are in secondary patterns from a trending perspective. RSP is a really good call out. RSP just a month ago is at the bottom areas of the market. Now you're talking about a V-shaped recovery back up above the 200-day moving average. And so you don't have a lot that are at the low tier any longer. In fact, a lot of the ones that are still at the low tier, you got to ask yourself, if something is still fundamentally sticking at the low point, you got to ask yourself what's wrong with that company, because the market's not that.
For example, Lucid Motors, which has been, and I use this because I hate Lucid because it has been my longest standing losing position that I can't sell cash flow on fast enough. Has it lifted off?
No.
Yeah, in the sense that it is not at the absolute lows, but it's not exactly participated, right? If you're a month into this, Matt, a month, like this week will mark you are into it a month now, this rally. If you haven't gotten some juice by this point, you probably shouldn't be looking that low in the chart for your next trade, right? Like you need to at least be like.
That's a great point, Mark, because the market's at the top, right? The market's at the top. The S&P 500 is at the top of the trend. The NASDAQ's at the top of the trend. Dow Jones at the top of the trend. RSP, which is the equal weighted index, is mid-tier, breaking above the 200-day.
Small caps kind of like a third the way up, right? Like
in process,
but certainly having patterns.
50-period moving average.
Yes.
If you do not have a stock that is above its 50 daily, you got to ask yourself a question. What's wrong with that company?
Yeah, there's something wrong.
Not the 20 SMA, but the 50 SMA, because every index is above it. The RSP, Russell 2000, all of the things that were just absolutely getting smoked, they're above the 50-period moving average. And so, yeah, that's a good call out. If you're looking at a stock and you're like, ooh, I think we might have an opportunity on Lucid as the market starts to maybe rotate a little bit. I can see people getting convinced on companies like Lucid that have just not gotten any love in this rally. And as the rally starts to kind of slow its momentum a little bit at the top end of its trend, I could see people coming in and be like, ooh, let's go look at things that have not rallied. And I got to ask the question internally and externally here, why did they not rally? Because this was one of the most significant rallies I've seen in a long time. That was based on a fundamental change at the central bank regarding the monetary environment. And if Lucid or companies like Lucid cannot catch a bid in that environment, why are they going to catch a bid now?
Yeah, no. And so like if you're looking for that next wave of trades, which I am, which traders always are, right? It feels like you have a backdrop that can be constructive, especially now through unemployment report and maybe through the end of the year, especially from a cash flow perspective. And I kind of want that sweet spot in the middle, Matt. I don't want the stuff at the very bottom, because screw that. If it hasn't participated in this rally, it's not going to. I don't want this stuff that's super overextended, because I'd rather just be patient and visit them again in 2 weeks. See if I get an opportunity. But I got a lot of stuff in the middle, Matt. We did not have any shortage of candidates to make our scatter reports.
No.
We did not have any we had a lot to choose from, and a lot of nice patterns kind of in that mid-tier, middle range.
Right around the 200-day moving average. A lot of patterns right around that. And I would describe the 200-day moving average as mid-tier. Would you agree with that?
Yes.
Anytime you're around the 200-day moving average, you're somewhere mid-tier. When
I am, small caps is right below it. RSP is right above it. But in that range.
You got a lot of stocks that are slightly under, slightly above it, obviously, with the Russell and RSP right there. And so, yeah, there's not a shortage of opportunities on catch-up plays against what the S&P 500 is doing. And so when you're looking at the next 2 weeks here, I, in general, have an opinion that basically we're overextended here. We're overextended from a technical perspective. And again, I'm looking at the broad market here, not the equal weighted index, but the weighted index, S&P. I do think you're overextended here technically. I do think you're overextended fundamentally. When you feel like, for example, I think it was 2-3 weeks ago, Mark, I made the argument that we were undervalued at this point and that we had an opportunity from a valuation perspective. That was in the heart of earnings season, like right after Apple Week. 3 weeks later, those valuations are stretched. You were, I think, right around 17.1, 17.2 on the forward P ratio. Now you're like 18.7 on the forward P ratio. 3 weeks ago, we were underneath the 5 and 10 year average. Now we're kind of above the 5 and 10 year average. When you look at Mag 7 across the board, a lot of overextended situations technically, and a lot of valuation getting stretched a little bit. And so I could see scenarios here, Mark, over the next 2 weeks where the top of the market kind of consolidates, that you see a little bit of slowing momentum, not shifting volatility. I've not seen, and again, volatility can come out of nowhere, Chucky. It can. And that's always going to be part of this game we call trading and investing in the financial world. It can come out of nowhere. But when you're looking at the current environment, I haven't seen a lot of volatility in these markets over the course of the last couple of weeks. When you're looking at the VIX for the love of all things holy and good, yes, I mentioned the VIX, but when you're looking at the VIX here, the VIX is just catering over and over and over again. You're now talking about levels on the VIX that we have not seen legitimately in the last few years, ever since the beginning point of the pandemic. And so when we're talking about there's not a lot of volatility at the top end of the market, there isn't. But what you do have is you have an overextended situation that is slowing down a little bit. And what I mean by that is you start to see these U-shaped formations. You start to see smaller candles. And this is not abnormal. These are very normal technical situations in market history where you start getting into a pivot zone, an overhead resistance zone. You're overextended going into that. It doesn't take the technical wizard to be able to paint to a little bit of consolidation is needed on these charts if we're going to see any degree of follow through here. And so I just think in general, when you're looking at the S&P, you kind of feel like we're a little bit overextended at the top end of trends. Well, if you know that, you're probably thinking the same thing about Microsoft, about Apple, about a little bit of Google, maybe some of those areas that have not seen significant downward pressure in the last 2 years, that are at all-time high status, that are at, an overextended situation at an all-time high status. Think Microsoft, for example. Microsoft is a wonderful, wonderful company. We love Microsoft. We're going to keep on trading Microsoft on any high base breakout. But at some point, don't you have a sense that, man, going from 310 to 380 on Microsoft in a month and a half on the second largest company in the world might be a little bit stretched,
There's a saying I try to use because when I get a brand new trader in the traders lounge for our pro members and they're asking questions and they're like, these big rallies draw in a new trader all the time, and for good reason, right? They're exciting, they're power, right? But when a new trader only brings up this type of chart and only this type of chart, I'm like, I start to be like, okay, I get a sense of who I'm dealing with.
Yeah.
And I'm like, listen, you are not going to make a living at trading only chasing things up 25% in 1 month.
I don't care what the name is. You're not gonna be
like, if that is the only type of chart you're ever looking at, you are what they refer to as the sucker at the poker table, right? There's an old saying in poker, Matt, right? Like,
that's the well.
If you can't spot the sucker at the poker table, you're the sucker, right? And you can't. I mean, it's not that these can't provide opportunities, and it's nothing against Microsoft or Visa. They're amazing companies, right?
They're very stretched.
But if all you do is chase stretch charts, well, once again, then, and if the only trades you have out there are on stretch charts, you're really susceptible on that.
If the only thing you're looking at is stocks that are at the all-time high that have just been parabolic held up, you're missing the beat on what this market is starting to produce. And it's producing opportunities, not just at the top level. It's producing a lot of opportunities coming from the bottom level and coming from the mid tier. Right now, we're really kind of focused on the mid tier, but you get my point here. And I think you're kind of on the same level. Is nothing against Microsoft. I actually really like Microsoft above 380, and I think it goes to 400. But once again, that's a trade. That's not, you wouldn't be looking at Microsoft to pick up Microsoft at 380 with the RSI at 70 with a forward PE ratio of 32 from a longer term perspective. You just would not do that, or you should not do that. You should wait for a better situation from a fundamental and a technical perspective. And so, yeah, you see the top areas of the market as momentum trends, momentum trades, and and as long as the momentum plays out, that's fine. But Mark, if there's any weakness coming down the road, a lot of these levels, once they give up support, we know what occurs. Violation support, volatility hits, and then they start forming bullish retracements. And so I just feel like from a technical perspective and a fundamental perspective, you're looking at stretched valuations and stretched technical analysis on many of the components that are leading the charge, such as Apple, Microsoft, and so on and so forth. Doesn't mean there's bad patterns in the Mag 7. There's some really good patterns in the Mag 7. I just kind of feel like the top of the market, coming back to my original point, is the top areas of the market probably need a little bit of consolidation, Mark. And when I'm looking at the next month, for example, going into December, which is typically a fairly decent month for the bulls, I look at these opportunities coming from those mid tiers like the RSP, like the Home Depots of the world. And there's a billion different charts like that, quite frankly.
We have no shortage of those candidates.
Look like that's where the opportunities are right now. And as we go through the next 2 weeks, I think both you and I are anchoring against labor market numbers in 2 weeks from now. As we go through the next 2 weeks, I could see a lot of scenarios, Mark, where we see a little bit of consolidation at the top end of the market, where bottom solidifies, mid-tier confirms, play a little catch up while we go through a little bit of consolidation. But what in that consolidation, what we would really be seeing is Mag 7 and Mag 7 components tapping on the brakes a little bit of a yield sign coming up, a little yellow light on the stoplight. They tap on the brakes a little bit in the charts like Home Depot, Builder, a lot of the cyclical components, basic materials, they start to catch up a little bit. And so I don't want to say negative things about comms, discretionary, and technology. Those are the highest rated sectors for a reason at Tackle Trading, but they're also extremely stretched right now when you're looking at technology in general. When you're looking at technology in general, for example, you're stretched. RSI is at 80. You're starting to come down a little bit. When you look at communications, once again, same type of conversation where you got RSI at 79 coming down a little bit. You're a little bit range up. When you look at discretionary, RSI was at 80 coming down to 70. And so you're looking at a lot of stretch situations in the market going into next week. Let's see what we get. But in general, and again, my main point is the areas that are at the extreme top areas of the market, they probably need a little bit of consolidation to reset their technical situation, to reset some of these valuation concerns. Because again, when you're overextended, Mark, do not hear that as price has to come down. Price does not have to come down for these valuation
not adding is much different conversation, or taking a little profits is a much different conversation than are we looking at the next round of bearish trades. Those are
I don't know about you, but I'm not.
No, I'm not. Not this week. I'm prepared to. I have to see one of two things. One, I have to see a macro narrative that's like, oh, that's not going to happen this week. So I don't even think about it.
I don't think that happens.
And I got to see shifting volatility. I haven't seen it yet. So until I do, and if I see a shifting volatility on Wednesday, I won't do any bearish trades on Thursday. I'll think through it on the weekend. Well, right? So I'm at least 1 week away from my next round of bearish trades, and probably longer.
Yeah, I would say it would take a week in terms of development, and that's
Like at a
you got
minimum, like
everything you needed to see from
it might be January for all I know. Like,
yeah, like I
like
you always have like you're always going to have
oh,
the
there's always things to piddle with, right?
yeah, but
There's
we're talking
always
about that bear opportunity.
like, oh, I'm going to add some sizable bearish hedging, type thing. So
I think a good example of what I'm talking about with the overextended situation is happening a little bit this week in both comms, discretionary, and technology. You take discretionary, for example. Discretionary in the last week and a half really hasn't done anything. It's consolidated, unlike a lot of other things in the market that are just kind of fade up, fade up, fade up in the last week and a half. Discretionary really is consolidating here. In that consolidation, you have not given up a penny. You haven't. You're during at the beginning of the consolidation, the top end of the candle was 168. You're currently at 168.24 now. You haven't really budged at all from a technical perspective.
Matt, these charts have been so calm, and with the VIX falling, so it's not a surprise I'm at all-time highs in my account at the end of the week, right? Like this has been an insane cash flow stretch.
Well, it's been an insane directional stretch.
It's just been insane. It has been a get healthy stretch. It has been a get healthy stretch.
Yes. My general point, though, is price doesn't have to come down for the technician to see the overextended conversation differently. For example, in discretionary, last week and a half ago, you're talking about RSI around mid 80s. Currently, you're talking about it at 70. Consolidation at the top end of trends will reset the technical conversation. I talk about this all the time in resetting technical conversations. And so as long as we consolidate here, Mark, I'm going to tell you right now, the best setup going into December is 2-week consolidation, breakout on positive labor market news, and let's all party for the next 3 weeks like it's 1999. That's the best technical situation, in my estimation, is short-term consolidation, bring down the technical overextended conversations, and give fresh eyes on a potential multiple time frame breakout. And while that occurs, that's top of the market stuff. While that occurs, Mark, I just feel like you got some decent catch up in RSP, which is now just breaking out of the 200-day moving average. And if the Russell 2000 can break here, it's got a really decent consolidation right now that is coming from the low to mid tier. You break out of this consolidation and get above that 200-day moving average, I think you got some opportunities there as well. And so the concern that I have is not in the Russell 2000 technically. I don't think you're overextended right now. You're at 457 for crying out loud. RSP, for example, a little bit better than what we're seeing in obviously the Russell 2000, because you still have the Apples of the world in RSP, and so that's doing a little bit better. But again, just still a little bit more of that catch up in it as well. So I think the opportunities certainly do come from the mid tier
mid tier.
Now, every aspect of fundamental and technical analysis right now. Does that change? Yeah, that could easily change with a couple of weeks of consolidation, and we get some really good situations on some of those high flying stocks. But as of right now, I think you tap on the brakes a little bit top tier. You look a little bit mid tier right now.
Yeah, and I'm going to give a shout out to one bottom tier stock, FCX, because I really like this from a cash flow pattern, and I really like what copper's pattern is doing.
I would put FCX in a vastly different conversation than the Lucids of the world, though.
Yeah, no, because it
is more like intermediate neutrality here.
And so, I mean, there's opportunities. I just think for this coming week, don't look at the top of the chart. Like that would be, I think that's both of our general takes here.
Yeah, and again, if you're momentum trading Microsoft above 380, that's a different conversation than say what we've been generally talking about. Apple here probably needs a little development. So yeah, I think I'm right there with you, Chucky.
Take a little profit. Just take a little. There's nothing wrong. Take a little profit, reallocating it into some other areas right now. Now, one top of the market chart that had earnings this week, and we touch on this, is old Nvidia. You and I did a coaches show for our pro members, and we came away and we did not prep together for that coaches show. But our conclusion on Nvidia is a freaking amazing company, not exactly news at 11. But one of the big things in talking, we talked Nvidia and we talked AI and we talked semiconductors for an hour plus. Matt and I just check that out.
An AI conversation regarding the marketplace. Definitely check out the coaching show from last week.
Now, Nvidia is one of the top of the charts that has broken the 9. We have very few individuals that have done that. Now, it's always interesting post earnings, Matt. Like post earnings is always interesting because it almost has nothing to do with the earnings report unless it was like, oh my gosh, one way or another, right? Like, and the things that can develop, like Nvidia is a long-term ad, but exhibiting short-term weaknesses. Talk just a little bit about the current chart and then about the Nvidia's earnings, because I thought they cemented to me, I'm done questioning this company ever until they force me to question.
That might be a while from now.
Like I'm assuming that they're rock stars until they show me that they're not. I'm giving them that status.
They're going to be here for a long time then, because they're not changing that tune anytime soon. These raw numbers coming out of Nvidia are just absolutely something to behold. Nvidia's earnings in 2023, I don't think I've ever seen anything like this.
I just got to make one comment before you get going. I saw bears trying to nitpick their earnings for a few hours, and then they just stopped giving. They just gave up.
I don't know why you would nitpick these earnings numbers.
Bears do that.
There's a lot of, yeah, but why are bears even fighting Nvidia?
They love to fight Nvidia for some reason. They see it symbolic of everything, like
symbolic of massive growth. With
I know, right?
Like it's just absolutely ridiculous. Go fight Tesla more. It's the most heavily shorted stock in the history of mankind. You guys can go fight over there. Nvidia, what are we doing here? Nvidia came in with absolutely amazing raw numbers, one of the best in the quarter. Obviously, 3 consecutive earnings reports that are just the best of the best of the best that Nvidia has ever produced. Nvidia came in raw numbers 392 versus 318. Revenue came in at 18.12 versus, I believe, the 16.12 billion expectation. Guidance was up across the board from a revenue to an EPS perspective, both for the quarter as well as 2024 as well. So raw numbers were really, 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 really solid. There was a little bit of a warning on China and specifically the export restrictions that the Biden administration through the CHIPS Act has put against exporting semiconductor components to China. And so Nvidia, which does a tremendous amount of business with China and quite frankly, a tremendous amount of business with everybody around the world, they did warn of that regarding China, but that's also cooked into their earnings, to their guidance in general as well. And so I wasn't too concerned about the Chinese conversation because that's embedded in their guidance, Mark. And that's the thing that the bears didn't get when they were all just, talking about Nvidia and China on Wednesday, is the fact that it's built into their guidance, which was absolutely outstanding. Now,
and this is the thing I've learned about Nvidia is Apple's going to have to be careful to lose king of manipulating guidance so that you always keep expectations. Nvidia plays this game very well. Any guidance they give, I believe that they are being very conservative on their thing. And so
I believe they're being conservative on their guidance numbers as well.
Yeah. And so I think they are we are going to be very conservative here. So if they're already baking in lower expectations in China and growth everywhere else, these are conservative. These are conservative numbers they're giving out.
Well, I think Nvidia can be very conservative on how they go about their guidance and their expectation on growth, because they don't need to spark any of that mentality in the market. The market's already there. And so I think they can play the Apple game. And Mark, the Apple game is to completely low bar expectations so that you constantly overachieve at low bar expectations. And Apple plays it better than anybody.
Nvidia, though, I think Nvidia needs to be given a little. I mean, they do everything else well. I think they're gonna.
When you got that fundamental backdrop, that much cash flow, that much revenue, you can play a little these conservative guidance games a little bit better than the other companies in the marketplace. I felt, and we were talking about Nvidia on the coaches show before they reported or right after they reported earnings, but you asked me a question technically, if it gaps up, if it gaps down, if it does nothing. Mark, we got a very, very muted response technically from Nvidia's report this week. And when you saw a very muted response, some people took that as losing a little bit of momentum. I did not. I took that as, wow, we did not skyrocket up, which would have left everybody behind. Everybody would have been like, ooh, look at NVIDIA go. And it's like, yeah, but did you have a trade on it? No, because you didn't have a good quality pattern. Well, yeah, I'm glad we didn't play that game. I'm also glad we didn't play the Walmart game where we gap down and immediately start getting into buyers analysis. What we got was a muted response on NVIDIA. And what I feel like that set up is the potential of a really solid bullish retracement situation here. And so whether or not we get a bullish retracement or a flag-based pattern on NVIDIA, I do think this is, and there's a couple Mag 7s to keep your eye on this week. Amazon looks amazing right now. Looks absolutely amazing.
And Matt, talk about the type of catalyst. Let's say I'm seeing online sales data that is going to be reported as very robust.
All expectations are improving from last year. I think 13% additional. I think consumers are expected to spend 13% more on holiday sale season.
If you see these type of reports, which we are, this is the type of catalyst. Let's break that resistance level. It is the one Mag 7 stock I think I could get behind.
Well, it's because it's mid-tier.
Because it's mid-tier.
It's mid-tier. It's catching up. It's not top of the market, but I'll just do you one better. I don't think Amazon needs a catalyst here. Like, yeah. I don't think they need amazing.
Well, I think you're going to get a catalyst. I think basically I'm saying be prepared early rather than later on this one.
Yeah, I'm just saying, I know a lot of people constantly wait on, oh, Black Friday is so important for this. No, it's not any longer. Black Friday is not as important to the retail space as it once was, because we have Cyber Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and Sunday every single day. And so to me, I just love this technical story more than absolutely anything on Amazon. So again, when you're looking at Mag 7 this week, a couple that you want to keep on your radar. Yeah, in general, overextended, but a couple you want to keep on your radar. Amazon is one of them on a potential breakout. Nvidia tracking a bullish retracement of really compelling technical pattern. Meta breaking out of a potential high base is something that is interesting. Off the beaten path here, you still got Microsoft at above 380, but you're really, really elevated. Apple needs to go through a little bit of pattern development. It is in the process of that. Google could be one of the best multiple time frame conversations that we have this year, 2 to 3 weeks from now. As of right now, you're overextended going into that. So on the radar this week, you do have Mag 7, but in general, out of Mag 7, I would say the ones that you're really focused on are NVIDIA's retracement, Amazon's breakout, and Meta's breakout. Outside of that, I'd like to see a little bit more development in the Mag 7.
Yeah, no, great analysis, great analysis. Let's shift gears. There's been a nice little equity conversation. I just want to spend a very brief time talking the Fed, because the Fed has 8 billion speeches this week. They've been out there preaching higher for longer. I mean, what are they trying to do, Matt? Like, what are they trying to do? What are they trying to accomplish? Because they're not shutting up, and their message has been like, they got calls sold that they're worried about them going against here? No. You know,
they're worried about the market pricing in all the cuts next year before we get into next year. They're talking it down. That's all they're doing. It's a word game. That's all it is. It's a word game. Market's pricing in 3 cuts next year. The Fed's not prepared to put in 3 cuts next year, and so they're talking down the market. This is something you and I are very familiar with, by the way. Market aggressively prices in. Fed tries to talk it down. Fed, for example, yields going down. Mark, my expectation is yields are not going to continue to come down like this. And so why did they come down aggressively like this? Because the market priced in the expectation. And if the market prices in too much of the expectation, the Fed's got to reassess the situation. So I just see this as a word game. They're trying to talk down the market from going too parabolic, and they're trying to talk yields going from down, trying to stabilize. So I just see this as a massive just manipulation tactic by the marketplace or by the central bank. I don't see them. And I guess my general point there would be higher for longer. I just don't understand that. I don't understand that language with the data we're seeing. Like, and I don't think many people do in the marketplace. And so higher for longer. What else do you take away from the Fed keep on doing that when they've stated in general that the bias is to the cut side? And so I don't know. You tell me.
I don't know. I
don't believe their speeches. So I don't know what they're trying to accomplish with coming out with more higher for longer, because again, I think it's kind of expected that if we double dip inflation, we're going to get another interest rate bump. I don't understand what the point in the Fed coming out and trying to talk this down is. You tell me.
I don't know. I don't know. And this will be the only time I spend any time thinking about the Fed this week until the next podcast.
Think about the last 45 seconds of this podcast. You asked me a very simple question on why the Fed would continue to come out with speeches over and over referencing higher for longer. There isn't a good answer to that. There isn't, because the Fed itself in the minutes from last week didn't suggest that. The Fed in its policy statement did not suggest that. The Fed in the press conference, Jay Powell in the press conference 3 weeks ago did not suggest that. He was asked many times, and yet he didn't even hint towards it. And yet over the last 2 weeks, we've seen a lot of Fed officials coming out saying, oh, no, we might, higher for longer. Is there any other explanation, if you know what the Fed's been doing over the last 6 weeks, than they're just trying to talk down the market?
Yeah, no, that's the only thing, that they don't want things to get too crazy. And so they're trying to, that's the only thing that makes any sense, because they're worried about, they dealt with 2021, right? And I think that's probably in the back of their head into that, where things just went, they just don't want a repeat of that. And it's
they're repeating it. They're repeating it on the opposite side of the equation. How vastly wrong they were on transitory, and their absolute stubbornness and refusal to come off that idiotic language and mentality towards the inflationary that was staring at us coming out of the pandemic spending. They're doing the same thing here. They're losing credibility, Mark, if they just come out with the same bullshit speech over and over and over again when it doesn't equate to what they're actually doing in their policy. Mark, higher for longer, we've had 3 interest rate increases this year. I know it feels like we've had 30. We've had 3, and we've had like 1 in the last 6 months. And so at what point can we have a different conversation than some B-lister Fed speaker talking higher for longer when that's not what Jay Powell is referencing?
Yeah. So, the Fed, something interesting will make them relevant again.
It is truly astonishing how never mind. Let's move on. I don't want to.
Let's go look at something prettier. Give me, listen. I want to just
talk. That's how unimportant the Fed is.
They're just unimportant.
I'm ready to talk about the Fed because
Jay Powell speaks on Friday, and we just lumped that in with consumer confidence on Tuesday from the conference board as relevancy. Like, it's just.
They had Jay Powell's speech 2 weeks ago colored red when he was doing a thank you to his data researchers. Like, literally, he was giving a speech to the research team at the central bank, basically saying, thank you for doing all of this wonderful research. He didn't mention anything regarding the market, and that was a red report on the calendar.
Yeah, no, give me copper. Listen, China's pumping, Matt. They don't stop pumping. They're very subtle in their pumping. Copper has a really nice bottoming pattern. This is coming off just from a technical, well-behaved, patience. You know, if you want to play China, there is probably no better instrument in the world than copper, right? You know, like it's China's been very crafty in how they've done this year, haven't they? Like just slow, steady, methodical, piecemeal, but they've been relentless. They've been consistent, man. You know, what do you think about this copper pattern here?
I like the bottoming nature of copper here. Very similar to what we're seeing, obviously, and it's proxy FCX. You were kind of on this one before I was. I like it now. You liked it literally 10% ago. So you're gonna have to take this one because I think there's better opportunities in copper specifically from a technical perspective. There's a bit, like I said, there's a billion charts out there that look pretty decent. You can be selective on those. And so I wouldn't see copper as a tradable instrument, given the fact that there's a lot of overhead here, but it is a vastly improving conversation out of copper. I'm not on the China freight train as much as you are either. And so it, to me, it's not a stay away, not at all. I like FCX quite a bit. I just don't specifically like copper as much as I like FCX. I like FCX,
Yeah.
but I like FCX for different reasons, not related.
Cash flow, FCX, go lob a naked put, buy some shares, sell a covered call, get some cash flow working.
That's how I'm approaching it with FCX.
This is a theme that just keeps on kicking. Let's talk gold. Like Matt, gold has done everything in the last month you would want it to do heading into a breakout. And I think that's the story on gold right now. You agree?
That's the only story I'm here for, is the consistency of the technical fundamental conversation as we start dialing in a potential breakout of what could be a significant price point.
Because part of me is you had to take a hit. For me to get excited about a break of 2000, somewhere along the way, you had to have several days of selling pressure. We got that. And gold said, let me buy that up. Let me scoop that up. And boy, you know, one of these podcasts, we're going to have a conversation. We're like, Matt, you know, we've been 2 weeks above 2000 and we're just hanging over here, right? It feels like this could be the time that leads up to that, doesn't it?
There's nothing in gold that I've seen over the course of the last month or so that would get me off my stabilization argument that we needed to see some degree of consistent continuation pattern going into the potential for a sustainability trend above 2K. We've seen gold above 2K. We've seen it in momentum conditions above 2K. We've never seen it last above 2K. This conversation is about it lasting and sustainability above 2K. Now, obviously, future holds what the future holds, but I love the price action and love the story that is going on in gold as we are approaching that 2K barrier. Mark, I labeled it, oh man, what was it, about a month ago? Listen, I want to see a cup and handle. There is nothing in the data that I am seeing so far in the last month to suggest that we're getting anything besides a cup and handle here. And so when you're looking at the cup and handle formation from a technical perspective, you can come join us on the halftime report as I break this down every single day. But if you look at the cup and handle, the only add that you want to really add in terms of a front running is on the not the cup but the handle portion. And right now, that's just not where you're at. Right now, where you're at is you're a little bit elevated. You're breaking 2K. You're coming into a 2020 pivot. And so you got to let that work out a little bit from a technical perspective. But the reality, Mark, is this conversation that we have technically on gold is really a fundamental conversation. If you don't have gold, my message and my mindset has been add gold. Like, you don't need to wait on the technical conversation. You don't need to wait on that pristine, handle in a cup and handle formation to front run in front of a 2020 breakout where you add to it. And if you don't know how to do that, don't worry about it. It's gold. You have a great pattern. It's got a great fundamental argument. Pausing is positive for gold. And so if you don't have gold, I think you add gold to a portfolio.
Yeah, you do. You do. Maybe the most interesting commodity event this week, well, it is OPEC is meeting. There's been no shortage of drama around oil lately. We talked more extensively about it last week. If you missed the podcast, that was a much more deeper conversation than the one we're going to have. But there's been some, OPEC, Saudi Arabia is trying to, you know how you have the House whip trying to whip up votes, right? When there's a major piece of a legislation, they try to whip up votes. And well, Saudi Arabia was supposed to meet today, Matt. OPEC Plus was supposed to meet today, but they had to delay it a few days. Saudi Arabia is out there making sure everybody's on the same page, and so they delayed the meeting till Thursday. They're just, they wanted to have they had to delay the vote.
Well, they've delayed the vote multiple times, but do you also think the delay might have to do with something regarding the ceasefire agreement in Israel and the exchange of hostages?
I don't think so. I think the scuttlebutt I heard, and maybe, these are very complex matters on geopolitics, so it might, I heard.
So happened to be the day of the announcement of the ceasefire was the day they delayed the meeting.
I heard Nigeria and a couple African oil producers were not happy with
nothing surprises me on that. I'm just saying, like, there's some major things happening in the Middle East right now that are more important. That's all I'm suggesting.
Now, oil has been very cooperative in forming bottoming formations when it does, right? Like you look back, and this goes back, I don't know, like my whole life, right? It's very, when oil puts in a bomb, it usually takes a month, right? It usually takes a while. Could that be occurring here over the last couple of weeks?
I don't want to really kind of detail the technical conversation because people can't see it on as we're talking about it.
But conceptually,
yes, oil does not V-shape recover as much as
it's very unusual.
Let's do. In fact, gold, which you would probably think if in just a pure situation between gold and oil, that you would think gold does not V-shape as much as oil does, but it's actually the opposite. Gold will V-shape a little bit more than oil. Oil can be very, very, very kind in its reversal analysis.
Very kind. Very kind.
What I mean by that is it doesn't V-shape. It typically gives us double bottom, double top analysis.
Triple bottoms sometimes.
It is not abnormal to go a month or so in consolidation before you start to see an opportunity arise. And that's in general where I'm at with oil right now, Mark, is you're going through some fairly significant volatility right now in oil. Oil is going through a lot of shifting volatility at the bottom end of the trend. I don't love that look at the bottom end of trends. That means something far more to me at the top than at the bottom. And so I don't think oil's opportunity is this week, honestly, but OPEC is absolutely going to have something to say about that. But even if OPEC comes out and they cut to the level that they were expected to announce an additional 1 million barrels per day cut, that volatility is going to be really intense that day. And so I don't think we need to be in front of that, Mark. I think it would be a secondary pattern following the OPEC announcement so that we get the understanding about what OPEC is doing. Are they going to cut a little bit more right now? Saudi Arabia is cutting a million barrels a day. Do they add on top of that to 2 million barrels? Does OPEC Plus also agree to that? And does the market confirm a potential reversal here? If all of that happens this week, where we get the cuts, market reverses, big green candle, I would still suggest wait on secondary pattern. Because you gotta let this one play out. I do not ever feel the need to chase oil. I never feel the need to chase oil. Oil will always give you a better, more constructive pattern than chasing any big green candle. Because how many big green candles do we see big red the very, very next day, Mark, on oil? Oil doesn't go up, 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 and down, 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 down. It oftentimes will give you very good constructive reversal patterns. And so regardless of what OPEC says here, they probably will come out with cuts, I would say. But regardless, this is a technical conversation. Let's let that play out. And I doubt that's maybe by the end of this week, but not at the beginning of this week.
Yeah, I think there is a large opportunity brewing. You want this on your watch list just because of the disconnect. You can't have cyclical US equities partying. You can't have copper on separate analysis also set up to party. So you have China and US economic. You can't have both of those. And then oil just, oh, let's just sell off and go to oblivion because I don't know why, right? Like, there's a disconnect, and those disconnects usually resolve themselves with well, they always eventually resolve themselves, right? You'll never see copper trending dramatically in the opposite direction of oil. You'll never see cyclicals trending dramatically for extended period of times in the opposite direction of oil. I think you're setting up for an opportunity on that, because nice little disconnect, right? Nice little disconnect.
There is, but you got to let it work out.
So
I think you got to see OPEC first.
Yeah. So, all right, Matt. Well, an enjoyable podcast on my end. Hopefully it was yours. And most importantly, hopefully it was for all of our listeners. Matt, give some thoughts, as we head into the week.
Yeah, it's one of those weeks basically where you're dealing with some overextended situations in the marketplace. You're probably more on secondary pattern watch, trade management, profit taking, getting ready for the next bout of trades. And I think that's in general, when you get to these level of overextended conversations in the market, it's not that there's flaws in the market. There's just flaws in the price you have to pay for the market. And that's when you want to get a little bit of a better technical backdrop, a little bit of a better of a fundamental backdrop. So I do think in general, people are starting to tap on the brakes just a little bit. I don't get me wrong, I'm not talking about fading this rally, not at all. I'm just saying tap on the brakes a little bit as we're overextended coming into some major areas. And that's in the S&P. When you're looking at some of the other areas of the market, that's a different conversation. And so top shelf stocks probably need a little bit of time to simmer down. RSP, Russell 2000. Let's see if we can get a little bit of confirmation this week on that end. Outside of that, at Tackle Trading, who is our sponsor of the podcast, at Tackle Trading, every single holiday, let me rephrase, every single time this time of the year, right around the holidays, right when Thanksgiving hits, right going into the Christmas season, we put all of our programs on discount, Mark. We call it the annual holiday sale at Tackle Trading. And this is a great time if you're looking to get an annual membership. For example, you can get a nice little discount against your annual membership, 23% off at Tackle. If you're looking to solidify your working with a one-on-one coach going into next year as a New Year's resolution, our coaching programs on discount right now. Everything, all of our premium systems are usually $14.97. They're all on discount down to $7.97. And all of our premium systems are 6 to 9 hour on demands with mastermind groups, Discord access, you name it. And so this is just a great time at Tackle Trading. If you're looking for any of your educational needs, come over to the 5-star rated Trustpilot education company known as Tackle Trading, and we'll take care of the rest of it. So if you're interested in learning how to swing trade, get the step system. If you're interested in learning how to cash flow, you got the Tackle 25 or cash flow condors. If you're interested in learning how to protect those investments, we got Bear Market Survival Guide. We got the day trading course, Hard 14. A lot of our premium systems on discount right now. But if you're looking for a community to navigate the market with next year, definitely get that annual pro membership. Take out that subscription on a monthly basis. Get a nice little discount on the annual. You can get all that at the storefront at tackletrading.com. And with that said, I'll leave final thoughts to you.
On that, like this time of year, because I do the customer service at our little company, team at Tackle Trading, and man, I think I might be the most experienced trader in the world to do customer service for a company. It's true, but like that was an important thing for our company. But I'm very,
vision though.
Yeah, it's like, hey, when you send an email to Tackle Trading, you're gonna have an experienced trader answer that email. Mm-hmm. But listen, I'm very busy this time of year with customer service. People always have kind of questions on this and that. Hey, I don't understand this. Can you give me a call? Will you help me? Hey, here for all of it. here for all of it. So email me if you have any questions, anything at all. Happy to get you on the phone. Happy to help you on the computer. Just whatever you need. Matt, I get ready. This is one of those. You get ready. You don't take vacations for the next few weeks because it's very busy, and I get in that I'm going to be busy mindset.
Well, and if you need any help, you can obviously email Mark at Team at Tackle Trading, and he will help you out with anything you want. You can also set up a consultation with Coach Sylvia for all of your educational needs as well. And you can get that consultation link right there. It's in the storefront under the coaching program. You can see schedule consultation. You can schedule a consultation with Coach Sylvia there as well. With that said, we're out for today.